Hey, what's up guys? Welcome back to the channel and I hope you're all doing well. In this video, I'm going to go over 5 dividend stocks that are my picks for the month from the hundreds of stocks that trade on the TSX. I'm going to cover the recent financial figures, valuation metrics, and provide my analysis on why they are my picks for the month. So make sure you stay tuned for the entire video. I'm also going to provide any recent business updates so you have an idea on where these stocks are potentially headed next. So without further ado, let's jump right in. The first stock up is Enbridge, ticker symbol ENB. Enbridge is one of the leading North American infrastructure companies with a vast network of pipelines. Since our reliance on natural gas and crude oil isn't going away anytime soon, we have to rely on Enbridge's pipelines to deliver this valuable resource across North America. This should result in Enbridge to continue to grow its earnings and revenues for the years to come. Enbridge is currently trading at a price over $50, coming in at $50.15. It has a market cap well over $100 billion, a PE ratio of 16.05, earnings per share at 3.12, and a very healthy dividend yield of 6.66%. Enbridge pays dividends on a quarterly basis in March, June, September, and December of each year. Even though Enbridge has a payout ratio of over 100%, it generates enough cash flow, enough growing cash flow to continue paying a healthy dividend, but also to grow that dividend, as their most recent dividend was 83.5 cents per share. Their 3-year dividend growth rate is 8.37%, and they have a 5-year dividend growth rate of 10.62%. Looking at Enbridge's recent financial performance, you'll notice on the company's latest quarterly results that everything from revenues, net income, diluted EPS, profit margin, and operating income, it has seen growth as Enbridge continues to recover from the impacts of COVID. Indications are that Enbridge will be able to continue to increase its earnings per share over time. And as an investor into Enbridge, these are the exact type of results that you want to see. You want to see that strong growth. You want to see strong earnings, so that way they can continue and pay a healthy dividend. Enbridge currently has a return on equity at 10.84%, and looking at its 5-year performance, it has seen a stable share price favoring dividends over capital appreciation. And when we look at the most recent 1-year performance, it has seen a 20% appreciation as the business recovers from COVID-19. Looking at the analyst recommendations for Enbridge, Enbridge is a mix between a buy and a strong buy. If you don't have this stock in your portfolio, you need to give it strong consideration. Plus, with a price target as high as 60, there is still plenty of upside to come, and you can lock in a yield close to 7%. Not many stocks out there are paying these kind of monster dividends with room for even more growth. 25 years of growing dividends uninterrupted through the dot-com crash, through the financial crisis, through COVID-19, and everything in between. This is why investors love Enbridge. In my view, Enbridge is one of the best income plays on the TSX right now. And I will say this repeatedly, if this is not in your portfolio, give it strong consideration. Enbridge intends to increase its dividends over the medium and short term by at least 3% per year. The remainder of the company's cash flows will be reinvested into expansion projects and balance sheet improvement initiatives. For long-term investors, this is a very good thing, as Enbridge operates in a very capital-intensive environment, and for it to be able to continue to grow its earnings, it relies on being able to invest in capital-intensive projects. In short, Enbridge provides excellent income and total return potential for long-term investors. If you're new to the channel or you've seen my content before, do me one huge favor, hit that like and subscribe button. It does 2 things. 1, it lets me know to produce more content like this, and 2, you don't miss out on future stock picks. Next stock up is TD Bank, ticker symbol TD. Toronto Dominion Bank is a Canadian-based bank that operates in all of North America. Not only is TD one of the largest banks in Canada, but also the 5th largest bank in all of North America. It is both an online and brick-and-mortar financial services firm with over 14 million online and mobile customers. Its segments include Canadian retail, US retail, wholesale banking, and corporate. TD also has a very large retail presence with over 3,200 retail locations across North America. It's no wonder I see TD branches all over Canada. It's currently trading at just over $85 per share. It has a market cap over $155 billion, a PE ratio of 10.97, earnings per share at 7.77, and a dividend yield of 3.63%. TD pays out dividends on a quarterly basis, and they are paid out in January, April, July, and October of each year. It has a very healthy payout ratio at 40.67%, and its most recent dividend was 79 cents per share. It has a 3-year dividend growth rate of 7.28% and a 5-year dividend growth rate of 8.58%. Looking at its financial performance, TD absolutely smashed through their most recent quarterly results with major growth in all key areas. Revenue up 45% year over year. Net income has more than doubled compared to last year. Profit margin up 68%. Operating income up almost 170%. TD is well positioned for continued strong growth ahead. TD has a return on equity at 15.29%, and over the last 5 years, its stock has gone up 52%. And in just the last year alone, the stock has gone up 39%, showing a strong post-COVID recovery. When looking at the analyst recommendations, TD is a mix between a buy and a hold. More recently, some of the more hold ratings from analysts have turned into buy ratings. This is why you need to give it another strong consideration for your portfolio. With a price target as high as 100 and it currently trading below its lowest price target, this means that there is so much upside to come and you can lock in a yield close to 4%. There are not that many stocks out there with a great balance between a higher yield and room for growth. I'm a big fan of TD and all the numbers and analytics are pointing in all the right directions. The reason I like TD and chose it as one of my picks for the month is because it has a readily available network of retail branches and it has a terrific online platform. You can easily spot TD branches walking around any major Canadian or US city. TD gets more than 30% of its net income from the American division and has more than 1,250 locations across the US. So the company is well positioned for growth and diversified outside of Canada. If you're like me, you've likely become a customer of the big Canadian banks when your parents opened up your first checking account back in your younger days with either TD or with another major Canadian bank. And since then, I've opened up a TFSA, an RRSP, savings account, credit cards, and more from these large Canadian financial institutions. Fortunately for TD, most people are like me. When you open an account with TD, you tend to continue banking with that bank indefinitely because oftentimes it's just not worth the hassle of closing that account or switching banks. TD has also seen a nice run-up in its share price since March of 2020, and all signs are pointing that this run-up will likely continue. Shares of this bank are currently trading at a very favorable PE ratio. Not only that, but it also offers a growing quarterly dividend, which is expected to get a major boost once OSFI restrictions are lifted and banks are allowed once again to raise their dividends. This bank is definitely worth snatching up in July. Next up, Alimentation Couche-Tard, ticker symbol ATD.B. Couche-Tard doesn't have the highest dividend yield around, but its dividend growth rate over the last 10 years has been hard to beat. It also has a fantastic revenue growth and a very, very healthy cash flow. Couche-Tard may not look like it, but right now, it's one of Canada's best long-term growth plays. Over years of acquisitions and organic growth strategies, the company has quickly grown into a global player when it comes to convenience stores and gas station businesses. This strong growth is contributed to over 14,000 convenience stores across North America and Europe. Couche-Tard is currently trading at $45.70 per share, has a market cap over $49 billion, a PE ratio of 15, and earnings per share at 3.05. It also has a dividend yield of 0.77%. Pays out dividends on a quarterly basis in April, July, September, and December of each year. The payout ratio is less than 10% at 9.88%, meaning there's so much room for continued dividend growth. Its most recent dividend was 8.7 cents per share. It has a 3-year dividend growth rate of 16.67% and a 5-year dividend growth rate of 18.33%. And looking at its recent financial performance, ATD saw some mixed results in their last quarterly report due to COVID-19. It saw some positive trends in same-store sales for merchandise and fuel volumes as traffic is returning to ATD locations. Even with COVID-19 impacting results, ATD managed a remarkably strong year, both financially and operationally, as noted by the revenue increase of over 26% year over year. It has a return on equity at 24.32% and a 5-year performance of 69% in terms of capital appreciation. And the last 1 year alone, it's seen a capital growth 5% as it continues to recover from COVID-19. And when you look at the analyst recommendations, ATD has a very hard lean towards the buy side, with only one analyst giving it a hold rating in May, while all 13 analysts have given this a buy or a strong buy rating in June. As it's approaching the higher end of its price target, there is still some upside available at the current share price. ATD's overall valuation has come down recently. It's historically been trading at a PE ratio of 17, so right now as it's trading at a PE ratio of 15, it's considered to be quite cheap from a historical perspective. Honestly, it's very easy to overlook ATD because it has less than a 1% yield on its dividend. But while that initial dividend yield may be low, ATD has been busy growing that dividend at an impressive rate. For me personally, ATD is a great Canadian dividend stock, especially if you're looking for a strong defensive holding. Throughout ATD's 40-year history, it's always looking at customers' changing behaviors. With the electrical vehicle evolution coming to mind, ATD is busy planning to add EV charging station to its convenience store locations across the US and Canada. The company is also adding this charging station to its locations across Norway as well. And this kind of rollout would not even be possible without a strong network of retail locations. My next stock pick is Telus, ticker symbol T. Telus is one of the big three telecommunication companies based out of Vancouver, BC. The company provides a wide range of telecommunication products and services, including wireless and wireline voice and data. Telus has around 11 million paying subscribers and has increased its dividends nearly every year since 2002. In this digitally connected world, the demand for reliable and high-speed communication networks is always rising. So Telus is an excellent play right now. It currently has a stock price of $27.96 per share, has a market cap close to $38 billion, a PE ratio of 30.69, earnings per share at 0.91, and a dividend yield of 4.52%. It pays out a quarterly dividend in January, April, July, and October of each year. Even though it has a payout ratio of over 130% based on traditional calculations, Telus actually has a payout ratio guideline in 65% to 75% of net earnings per share. The most recent dividend was 31.6 cents per share, has a 3-year dividend growth rate of 5.6% and a 5-year dividend growth rate of 6.44%. And looking at its financial performance, Telus offers shareholders lots of market-beating growth potential, but it also pays shareholders an impressive dividend. In the last quarterly results, it has shown impressive close to 10% in revenue growth. While Telus hasn't been all that consistent in delivering record growth, that may change over the next decade as telecom companies stand to greatly benefit from the expansion of 5G technology. Telus has a return on equity at 8.7%, a 5-year capital appreciation of 31%, and the last 1-year loan, the stock has gone up 25%, showing a very strong recovery from COVID-19. And when you look at the analyst recommendations, Telus is rated between a strong buy and a buy, which makes sense considering there is so much potential with emerging technology such as 5G and digital health. Telus is well positioned to benefit from the next generation in connected technology. Since the launch of smartphones and data plans, more and more Canadians have become addicted to these smart devices, and this addiction has also helped Telus make massive amounts of profit. Even though the high payout ratio might seem concerning, Telus has shown time and time again that it has an ability to keep its dividend very safe. It's very possible that Telus' dividend growth rate may slow down over the next few years. However, Telus can continue to increase its revenue via a spin-off of its other business segments. For example, with the recent IPO of Telus International, we can clearly see that Telus is willing to spin off its profitable businesses to generate even more revenue. The success of Telus International also sets up a very bright future for the eventual IPO of Telus Health. My last pick, Canadian National Railway, ticker symbol CNR. Even though Canadian National Railway needs no introduction, it is engaged in the rail and related transportation business. The company has a network of approximately 20,000 miles of tracks that spans across Canada and Mid-America, connecting 3 different coasts, the Atlantic, the Pacific, and the Gulf of Mexico, with connections to all points in North America. In short, CNR is a well-run railroad in North America. It has a track record of impressive earnings growth. Just in the last 10 years alone, its earnings have delivered total returns averaging 14% per year. It's currently trading at just below $134 per share, has a market cap of close to $95 billion, a PE ratio of 27.02, earnings per share at 4.95, and a dividend yield of 1.84%. It pays out a quarterly dividend in March, June, September, and December of each year, has a payout ratio of 47.27%, and the most recent dividend was 61.5 cents per share. It has an impressive 3-year dividend growth rate of 10.44% and an even more impressive 5-year dividend growth rate of 11.49%. Looking at CNR's most recent financial performance, even though CN had some mixed results during its last quarter, CN generates enough cash flow to cover the capital investments needed to meet growing demand for its services. The company also has enough cash left over to pay dividends. In fact, the compound annual dividend growth rate since the company went public is about 15%. That's one of the best dividend growth track records in the TSX index. As a dividend growth investor who cares both about dividend growth and capital appreciation, I really like CNR because it has consistently outpaced the market. CN currently has a return on equity at 18.21%. In the last 5 years, the stock has gone up 71%. And in the last 1 year alone, the stock has gone up 11% as it recovers from COVID-19. And looking at the analyst recommendations for CN, it is a mix between a buy and a hold. Having said that, owning top dividend stocks and using the distributions to buy new shares is a proven strategy for building retirement wealth. CN is a great example of that. Here's why I like CN. The company is very well diversified. No one particular product accounts for more than 25% of its revenues. The company has one of the lowest operation ratios of all American railway companies that are publicly traded. Even though CN has a relatively low dividend yield, the company is committed to growing that dividend. In just the last 5 years, that dividend has grown by an average of 11.49%. That's an amazing dividend growth rate. The dividend growth streak has been nothing short of impressive. The company loves to reward shareholders by consistently raising dividends every year. For example, if you purchased a stock 10 years ago, you'll be looking at a sizable capital appreciation, but not only that, you'll be looking at an amazing yield on cost. Even though rail isn't heavily used as a method of transportation for passengers across North America, rail is still one of the best and most efficient ways of transporting goods. And with CN's large and growing network of rail tracks, it will continue to provide transportation services across North America and bring profits to shareholders. And these are my 5 dividend stock picks for July. This is why I love dividend investing. Dividend investing and dividend growth investing has shown time and time again that's a great way to build wealth, to build generational wealth. And if this sounds good to you, you can get started by considering the stocks that I've mentioned in this video. And if you want to learn even more about dividend investing or more of my recent dividend stock picks, make sure you check out these videos. Thank you so much for watching. This channel would not exist without your love and your support. So please do me another huge favor. Check out the links in the description of this video. I have offers to various discounts and sign-up bonuses. Every click directly helps to support the channel, as these are affiliate links. You can also follow me outside of YouTube on Twitter and Instagram. If you have questions for me, feedback on this video, or maybe you have ideas on future content, let me know in the comments section. And while you're at it, make sure you've hit that like and subscribe button. That's it for now. I'll talk to you in the comments section.